Tata Consultancy Services will start the Q4FY23 earnings season next week. This will be followed by results of Infosys, HCL Technologies, HDFC Bank, ICICI Bank, among others. According to a Bloomberg estimate, Nifty EPS is likely to grow 3.2% quarter-on-quarter in Q4 FY23E, while Nifty EPS grew 15% quarter-on-quarter in Q3 FY23. It saw degrowth of 12% quarter-on-quarter in Q2 FY23. Analysts expect Q4 to be a mixed bag, with banks, hospitality, aviation, and cement companies to report good numbers.
We expect the markets to be volatile in the near term, driven by two key factors. One is the earnings growth expectation for Q4 FY23, and the second one is what happens with the banking sector in US and Europe. Are there any more dominoes to fall in those regions? Especially with the earnings season in India, we expect banks to perform well with 15% plus credit growth. Margins being stable and no major hit on an M2M basis on their debt books. For consumer discretionary names, we expect the earnings to be weak, led by very slow demand from end consumer and inflationary pressures on raw material side. FMCG too should see lower consumption growth, especially in the rural areas. One segment in the consumer discretionary space which is expected to do extremely well is travel and tourism. We expect hotel industry to do very well. Apart from that, we also expect airlines to do well, also helped by lower crude oil and thus ATF prices. Another sector which should do well in terms of volumes and costing is cement. Volume growth should be in double digits, while on costing side, on the fuel and the power side, we expect lower cost QOQ, which will help EBITDA per ton improvement of close to 150 to 200 rupees per ton. We've not seen any major increase in pricing. In fact, the pricing could be slightly weaker QOQ for cement players. But overall, we expect cement players to do well in this quarter. In pharma, we expect domestic pharma players to witness mid-single-digit growth, while international or US business growth will come from G-Level for a few players, while pricing pressure across other products continue.
In Q3 FY23, the combined interest expenses of 888 listed companies rose nearly 31% year-on-year, whereas net profit of these companies declined 13% year-on-year, showed an analysis by Business Standard. From an investment perspective, analysts see auto ancillaries and manufacturing stocks as good bets on hopes of margin recovery in Q4.
Going into the result season, markets are light. Positions are not exceedingly bullish, and that's fodder for a rally which can occur. From a sectoral perspective and from an overall earnings perspective, the earnings season could be a more mixed bag. We are still seeing downgrades and lower earnings happening for commodity sector, and overall we believe that that trend could continue. Even in FY24, we'll see moderation from the sky high strong earnings growth that commodities saw last year, and that moderation could continue. BFSI had a strong purple patch. It has performed very well, and we believe that even in this quarter we would see strong numbers from lenders particularly, and that will translate to strong earnings growth. Thirdly, we've seen that margin seems to be bottoming out, especially for commodity users, specifically in case of auto ancillary sectors and selective manufacturing in brown and white goods sector. We are seeing that margins may be bottoming out, and this could protect earnings growth for some of these sectors. IT again is one sector where we are seeing divergence. Valuations are still expensive. Secondly, we are seeing IT companies have still shown a very strong divergence in wage growth for their employees, and which is sending out mixed signals overall. this sector is still likely to be in consolidation. The result season could be very, very important from a perspective of how this sector behaves going ahead. All in all, we believe that markets are still expecting 15 to 18% growth in FY24. The last quarter result for FY23 could be crucial in setting the tone. We believe the markets are slightly over optimistic. Our estimates suggest that we should clock in an earnings growth of about 12% in FY24, which itself is good enough for index to see a recovery.
Overall, analysts foresee markets to remain volatile ahead of the Q4 FY23 growth expectations and recommend investors remain selective. Today, markets will react to the RBI's monetary policy decision. Experts expect the central bank to raise rates by 25 basis points. Besides, global cues, foreign flows, and crude oil prices will continue to dominate market trends.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.